Start recording. Show my PowerPoint. All right. Screen sharing is. Oh, wait a minute. Is this PowerPoint sharing yet, real quick?
Yes, it is.
Okay, great. So again, thank you all for attending at Lane Construction. What we're going to do is we're going to go through 6 presentations that the teams have been working on various peers in the construction industry. We've set it up to go approximately 20 minutes per team. The way we've set it up is about 15 minutes will be mostly them presenting, and since we're doing video conference, it'll be easier to let them kind of finish their main presentations. And then we have a few minutes for Q&A, and then we'll move on to the next team. As I mentioned in my introductory video clip to you, this is going to be a little bit more of a financially oriented presentation. So it's really covering what an analyst, a financial analyst working on Wall Street, would be looking at when they evaluate one of your peers. So the presentations have 4 sections. First, there's going to be sort of an industry analysis that they're going to talk about, and talk about the competition and the industry and the economic sensitivity. Second, they're going to do a little bit of a historical financial overview on some of the key metrics of the companies. Third, they're going to talk about some of the multiples based on the current share prices and why the multiples are trading at premiums or discounts. And then finally, they're going to wrap that up with a valuation, and they're going to do 2 valuations. You're going to hear a word called an as-is valuation, where the companies they're evaluating are publicly traded, so they're going to look at sort of what's behind that rationale, and then they're going to make their own recommendation that will create a buy-sell hold, and whether or not they think that they're in good financial shape. So those are the presentations that we have set up. As I said, this is going to be a recorded session as a webinar, so anybody attending, feel free to watch at a later date, or you're welcome to put it on the Lane Internet and make that available. But obviously we have a full conference room there, so if anybody has any questions, like I said, we'll try and take a couple questions to the group at the end of each of the Q&A part of the sessions. But Mike, did you want to say any other words on top of that?
Yeah, just a couple of things, Joe. One is for you just to clarify what beta is. It's showing in all the presentations, and if you could just tie that to volatility. And then the second one is just as we're using this as a developmental experience here, so if something goes over our head, could we stop and ask questions just for clarification so we don't get sidetracked?
Absolutely. And again, for mutual benefit, one of the other what's in it for Lanes for the people in the conference room is that Lane is doing a leadership acceleration program in January, and one of the reasons why you're participating is that for the managers that are going to be at that session, this also kind of gives them an additional financial overview of some of the peers in the industry. Now, some of it, as I said, is kind of technical, so if you have any questions along the way, we're happy to give some definitions for the non-technical people in the room, at least the non-financial people. But one of the metrics you're going to hear about today is called beta, and what beta basically tells you is economic sensitivity of an individual company against the marketplace. So if they say the company has a high beta, that means they're very sensitive to changes in the economy. Low beta, low sensitivity to the economy. Another thing you're going to hear today is called ROIC, which is return on invested capital. The overall level of return on investment in the industry is something they're going to focus on a lot. And then finally, you're going to hear them talk about something called free cash flow. So free cash flow is profit after investment, and it's the overall cash flow that a firm generates, and it's going to be very important when they do their valuations. But if there are any specific things that you're asking about, because I know we have a large representation of people at Lane, again, we're either happy to talk about during the session, or we can follow up after the session and give you some sense of what we're looking at. Okay? So in the interest of time, let's go ahead and get started. I'm going to put a little clock here so that we keep track of time. But Granite, if you want to introduce yourselves, and you have the floor. You're on the clock.
All right, so we're going to be discussing Granite Construction. My name is Michael Adam.
Chanhua, Corwin,
Sumit
Sharma, Deepak Sharma.
All right, so first we're just going to get a little overview of our presentation. We're going to first talk about a little bit of background information on Granite. then we'll go on to the EIC and the multiples analysis, and then we'll move on and discuss ROIC drivers, DFI analysis, and wrap up with our final valuation for Granite. The first Granite was founded in 1922. It's headquartered in Watsonville, California. Its primary industry is the highway, street, and bridge construction industry, and its secondary is construction, sand and gravel mining, and other heavy and civil engineering construction. For purposes of this presentation, we're going to be focusing on their construction, sand, and gravel mining industry. And the reason for that is many of its competitors in the primary industry are private, so in order to get effective peers to compare them against, we had to analyze their secondary industry for construction, sand, and gravel mining. First, we'll look at their economic sensitivity. And Granite has a raw beta of 1.481. So this signifies that it is fairly strongly affected by changes in the economy. And if you look at Granite along with its peers, the market cap weighted average for Granite and its peers is 1.24. So again, this signifies that this industry is affected by performances of the economy.
Just to interrupt you, for the benefit of the group that's watching on video, just tell them what a beta of 1 means.
Beta of 1 means that it moves in conjunction with the economy.
So
1.41 means it's moving. If the economy rises, it's more significantly affected and will increase at a greater rate. If it's below 1, the economy is in a downturn and won't be as significantly affected as the rest of the economy.
So it's going to be 48% more sensitive to changes in the economy than the average company.
Right, and the market with its peers will be 24%.
Yes. Okay.
So, for example, during recession, government funding for construction decreases. So this industry will experience a downturn, and alternatively, during a boom, it'll increase. So next, we can see in comparison to its peers, Granite in particular is a little bit more susceptible to market changes in the economy than its relative peers here. And next, we're going to analyze this industry through Porter's 5 forces, and we're going to focus on 2 of these. The first one is entry or exit barriers, and barriers to entry in this industry are high. New competitors are faced with high transport costs, and the dominant existing players possess a stronghold in most regional markets. And also, new competitors are faced with increasing regulatory controls that make it more difficult for them to enter the market. And we expect in the next 5 years that the regulatory controls will continue to increase and that it will stay high for barriers to entry. We're also going to focus on intensity of competitive rivalry in this industry, which is high as well. In this industry, competition is based around pricing, and there's also a large number of small local firms in the industry. So this creates intense competition in local and regional markets, and we expect this to stay constant as well in 5 years. And next, we're going to look at whether Granite has any competitive advantage. And first, we're looking at the end-of-year ROIC here. In the most recent year, 2013, they had a negative ROIC and were performing below the industry average. And for 2 out of the 5 years, they had a negative ROIC, which is particularly not a good sign. And in analyzing competitive advantage, we're going to look at their spread. And for 2013, they had a negative 15.38% spread, which means in comparison to their peers, they're the second lowest. So their cost of capital is much higher than what they're earning on their invested capital. And in this regard, Granite does not currently have a competitive advantage over its peers.
Okay. So before we get into the multiples, we have to make several assumptions. For the tax rate, the historical tax rate for these companies were all over the place, but the majority of the past years was in a particular range and a believable range. So we wanted the average of that. The second one was that Eagle and U.S. Concrete had no EV over EBIT ratio, so we had to replace it with EV over the operating profit. And third, we had to use the average ROIC for fiscal years 17 and 18 instead of 15 and 16 because the 15 and 16 ROICs would have resulted in a negative spread, which had, the growth was unbelievable, really bad. And as you can see, Vulcan has a zero spread because the ROIC and the WACC are equal. Which means that
didn't realize you were going to be in a disco. DJ.
Okay. Vulcan is the oldest of these companies, and also this industry is very mature. So the ROIC and the WACC is equal, so the spread is 0, therefore growth is 0.
Okay, so based on these multiple analysis, we'll first go in depth with Granite itself. We determined that Granite is right now at a discount. That can be justified by all these ratios actually. Both the EV ratios and the price ratios, they're all lower than the market cap average. These market industry averages are mainly driven by Vulcan and Martin Marietta, which have the highest market cap share. However, even with that taken into account, the 0.51 and 7.1 for the two EV ratios, they're actually pretty abysmal actually. So these results we say are justified by the margin of 5.5% and the spread of 0.6%. So as Chan mentioned before, the ROIC for our multiple analysis is based on the 2017 and 2018 ROIC data. The reason is because in the previous slide, you can see that Granite currently has a spread of negative 15.38%. With that percentage, we got a ridiculous growth ratio, and with this new 2017-2018 ROIC data, we were able to get a somewhat of a positive spread.
So just for the benefit of the people at Lane, when we say a company has a negative spread, what does that really mean?
Negative spread means their weighted average cost of capital is currently higher than their ROIC.
So the weighted average cost of capital is the rate at which they borrow from the market, and
Right.
the ROIC is the actual earnings of the company.
Yeah.
So a negative spread means you can't pay back the banks and the shareholders, and you're destroying value.
Yeah.
So that's what they're really saying here about Granite. And then the margin is the pre-tax profit margin of 5.5%. That'd be the profit margin of the business.
Thank you.
Definitions.
So what makes these results actually pretty worse is that we gave Granite kind of the benefit of the doubt that they will improve their ROIC in the future years of 2017, 2018. But these results, the spread of 0.6 is still a dramatic improvement from their negative spread before, but it is still, the results are still rather poor. And then these price ratios, we believe even though we chose Granite's secondary industry as the basis of our peers of construction materials, we think these peers are justified because these price ratios are in line with the accounting data. So the P ratios are mainly determined or influenced by the spread. And usually with a high P ratio, the company usually has, well, specifically the price to book and PEG ratio, the company usually has a more equity-oriented structure. But with Granite here, the price to book is 1.81. And that signifies that they're actually a really high debt company in proportion to their market cap size. And just briefly mentioning the PEG ratio, it's just how much the company is willing to spend on its growth. And as you can see for Granite, in comparison to like Vulcan, which is like a really old company of 5.38, the PEG ratio is 2.41, which is kind of in the middle of the pack. So the other discount peers are US Concrete. They have the lowest EV to EBITDA ratio of 6.05% and a pretty low margin of 5.8 and a small long-term growth of 0.5%. We justify these because we believe they don't have a very good chance of improving their business. With that, US Concrete right now has a spread of 5.21, but with our data that we used, they have a spread of 4.9, so their spread actually decreased in the future years. As for Eagles, they have the third lowest EV to EBITDA ratio, but they have a very strong potential to improve at their growth rate, and their margin is very high. And we justify these because the changes in the construction material industries, which we'll talk about later in the presentation, will greatly affect Eagles in addition to Granite. And just lastly, Martin Marietta is also at a discount, even though they're really they're kind of a market average driver, but their EV ratios are still below the market cap.
So we'll go over the premium peers. Asia Cement has the third highest margin of 12.1%, and it also has the EV to EBITDA and EV/EBIT ratios. Asia Cement, however, is at a discount against its peers. But we extend it as a premium because Asia Cement is actually based in Taiwan, which is a developed country, yet it's still less developed. And also, Taiwan is just that much smaller, so there will be less business, less market cap, so there will be at a more uphill fight to be above the average. And Vulcan is, as we mentioned earlier, is a market average driver. It has the second highest margin at 15.7%, and the second highest EV, EBITDA, and EV over EBIT ratios.
All right, so I'm going to talk about the ROIC drivers in the CFI statement for Granite. So first, we're going to start off with the end-of-year ROIC, which decreased from 12.5% in 2009 to negative 5.4% in 2013, which is a 143% change. This can be reflected through the cash tax rate and the end-of-year pre-tax ROIC. The cash tax rate increased by 3% from 27% to 30%, so it had a little bit of an influence on the end-of-year ROIC. The main driver was the end-of-year pre-tax ROIC, which decreased significantly from 17.3% to negative 7.7%. If we take a little deeper and look at the operating margin, it decreased from 0.066 in 2009 to negative 0.024 in 2013. The main reason for that decrease is because of the gross margin, which decreased from 0.219 to 0.114. The reason for that is, although Granite's primary business, which is the construction industry, had a decrease in revenue of about 8% for the year-over-year for the third quarter, whereas their secondary business, which is the construction materials, which is what we're focusing on, had an increase in revenue year-over-year of 12%, and because of their primary business, it's really dragging down their margins. Their selling, general, and administrative expenses and depreciation expense decreased by 5.7% and 21.3% respectively, and that helps soften the blow of gross margin, but overall they still had a huge decrease in operating margin. Next, we'll look at invested capital over sales, which decreased from 0.381 in 2009 to 0.314 in 2013, which is a good sign for them. And that's mainly because the operating working capital over sales and the PP&E over sales decreased by 12.3% and 27.3% respectively. However, their intangibles over sales increased by 370% from 0.005 in 2009 to 0.024 in 2013. Then lastly, I'm going to talk about the CFI statement for Granite that we made. So it's off with gross cash flow of 34.7 and ended with gross investment of 75, which is a 216% increase from the 260% of the gross cash flow. The free cash flow ended up being negative 38.7, and that's mainly because of goodwill. Of that 38.7, we ended up with cash flow available to investors of 62.8, and that's mainly due to the change in excess cash. Of the 62.8, roughly 26 of it was paid out to shareholders, 20 of it being in common dividends, and 6 of it being in share repurchases. The next call is going to talk about the assumptions we made.
For our final valuation, we made 3 assumptions. First, we assumed that revenue growth rate would be growing at about 2.5%, which is a little lower than the IBIS World Report on the construction industry. Since Granite's core business is construction, we chose to go with a lower growth rate as opposed to the higher one reported for the sand and gravel mining industry. And secondly, we assumed that the EBITDA margin would be 9% in 2016, but it will decrease by 50 basis points until 2020, where it will remain at 7% throughout the rest of the years. And finally, we assumed that the tax rate would be 30%, which is just the historical averages of the historical years. And these assumptions led us to a stock price of $18.41, signifying a negative 97.01% from the stock price of 36.27% as of November 14. And our final valuation for Granite is a sell. And next, Deepak will be talking about the factors that will lead into our assumptions.
So we had 6 factors that led to our assumptions of having a forecasted share price of $18.41 and leading to a sell rating. The first of which is government funding. Granite obtains most of their revenue through the public sector, specifically local and state governments, but first I'm going to talk about the federal government funding. Congress enacted the Highway Trust Fund, which
Give room, I was trying to show you.
they enacted the Highway Trust Fund, which funds infrastructure projects within the U.S. And the Highway Trust Fund has an uncertain future because of increased fuel efficiency and stable tax rates. And the reason why increased fuel efficiency affects the Highway Trust Fund is because the trust fund is made up of taxes on gas. So increased fuel efficiency leads to consumers consuming less gas and therefore less taxes on gas for the Highway Trust Fund. Next, we have local and state government investment. According to IBIS World report, local and state government investment in infrastructure is going to increase at a projected rate of 1.4% per year. But it's going to be slow because local and state governments have more pressing issues to put their funding towards, and they're going to have to take away from infrastructure. And some of these issues include taking care of the aging population. And there's also going to be an increase in the cost of doing these infrastructure projects, and that's because of the yield on the 10-year Treasury note and the price of cement. So when local and state governments decide that they want to invest in infrastructure, they usually issue instruments such as bonds. And these bonds, the price of these bonds are based upon the interest rate, and we believe that there's going to be an increase on the yield on the 10-year Treasury note, which will increase the cost of local and state governments to do these infrastructure projects. And according to IBIS report, the price of cement is going to increase in 2015, which is going to lower Granite's profit margins and their EBITDA. And next, we have the value of non-residential construction. According to IBIS World, this is going to increase. So because of some recovery by the economy, firms are having a profit, and they're going to use this money to make factories and combat offshoring, outsourcing. And there's also going to be an increase in residential expansion. But this increase is going to be, it's not going to be sustainable. It's going to be minor because consumers are still weary of the housing market because of the Great Recession. And next Paul is going to talk about the ROIC chart for Granite.
So as you can see, the ROIC for 2008, 2013 has been up and down, and this is mostly because of the recession. And starting in 2014, the ROIC will increase. However, we do not believe this change is long-term. So this increase will peak in 2016 at 13.1%, thus justifying our belief of a short-term gain. So from 2017 onward, the ROIC would decrease and eventually remain stagnant at about 8.7%, barring any significant changes in the economy. And this is mostly reflective of our projection of the EBITDA margin earlier, where Granite experiences a temporary boost, but then drops off in the later year. And this ROIC chart tells us that the stock price is overvalued, and even though there will be factors that will help to build Granite, but eventually the negatives will outweigh the positives, and these negatives will eventually drop down the stock price to what we believe it will be at in the long run, which is $11.41. $18.41, sorry.
Okay, thank you very much. How about questions from Connecticut for the group?
Is that on mute? No. Any questions on that? How much of that did you get? The numbers. Yeah, Treasury, right? Yeah.
I'm like, I got it.
Are there any things that were going around that you need clarification on? You got the spread part and that?
I got a question. How you fellows said that you looked at Granite and you looked at only their secondary construction, sand and gravel mining to compare against the other quarry mining companies. How were you able to? What data did you draw from to? Are these numbers that you put out here? Are they simply what is relatable to Granite's that particular division?
The only reason we chose these companies for the only reason we chose these is because their main industry is road and highway construction, and we saw that those companies are actually mostly private and foreign companies, and they didn't offer a very good peer source. that's the only reason why we chose the second.
Most of the numbers reflect Granite as a whole. The main numbers that don't are the revenue and the EBITDA margin we got from later on. That reflects just specifically the mining part of their business.
But all of that peer data that would be in your presentations, Joe Perfetti talking, would have been the whole company data. So they looked at the peers of Granite as whole data, even though they were choosing the peers based on that they were in that kind of construction material segment.
Yes.
So you feel that the comparison is accurate because of that, or rendered less accurate because of that?
It would definitely be rendered less accurate because, again, like we said, Granite, with their secondary business of sand and gravel, they actually perform well and had a 12% revenue increase. And it's really the primary business that's dragging them down that's making them look so bad, where they had an 8% decrease in revenue. I guess it would make it less accurate, but.
Well, being accurate is a direct comparison, but in terms of a financial comparison, I guess the real point they're saying is, and that's, if you go back to the slide on the tree, I mean, the real jarring problem, go one more down, the real jarring problem Granite has is they actually lost money on an operating basis in 2013. And that was really what they're saying, their primary segment by declining was 7%? 8%.
8%. On construction, the revenue is down 8%.
Yeah, this is the corporate level stuff.
Yeah.
But that's where they're financially challenged right now.
Yeah.
Okay, thanks.
Did I read that correctly? It looked like the data was showing that Granite has been doing a lot of streamlining, downsizing. Did I read that in the numbers?
Well,
You had overhead.
in the overhead ratio, you go from 11% to 10.6. So they did do some cutting.
Yeah. To save on their core earnings reports. Their overall earnings, including both primary and secondary business, was a decrease of 2%. So that was after they softened the blow by doing a little bit of downsizing. Any questions?
You have to leave early?
All right, Joe. I know you want to keep.
Thank you very much. Keep this thing moving. So, which guys? KBR. All right. We're gonna, because this is gonna impact longer than our normal class time, I'm gonna kind of go in order of when people might actually have to leave to go on to another class. We're getting in the middle of finals week here. So KBR, you're up. You wanna go ahead and log in and download and upload your presentation? And again, you're still being shared, so whatever's on that screen should hopefully still.
Okay.
I didn't print.
Yeah.
Thank you.
I don't.
Jason.
Margins are so thin now. This whole street is ridiculous. Yeah.
And the cost of cash is so high.
Mm-hmm. Yeah. And is that due to risk? Yeah.
Haven't
Is that due to risk primarily?
cost. Well, yeah, risk. So if you have a low risk, you're going to have a lower cost of cash. But if you're a high risk, you're going to have a higher cost of cash.
Right.
And they're looking for any reason to increase that.
To just match up the risk rating? Yeah.
So it goes from about halfway to the screen. You know,
30% dividend payout ratio.
and obviously, very
Yeah,
simple.
they're kind of stripping the company out of the cash it needs to grow, huh?
This is the benefit of the common.
Like you said, with growth, just accelerate. So if you're flipped,
So say that again?
it's with the growth, if you're flipped, if you're
Right. Is this a power?
backward.
It's susceptible to.
So if you're the other way, if you're the right side where your cash is lower than your margin,
Mm-hmm.
see what I'm saying? Yeah.
All right. On to to share this now. Are you seeing the KBR presentation?
Yes.
Yep.
Yes? Okay. How do you go full screen? Okay, let's go ahead and get started.
So first I'd like to thank you all for tuning in and watching our presentation, taking time out of your busy schedule to watch us. So we are KBR. My name is Kimberly Godfrey. I'm Sarah Eng.
I'm Gerard Smith.
I'm Nicholas Arvin.
And we are presenting on KBR as previously mentioned.
You have to use the forward and back buttons, I think, on the keyboard.
Okay. So to begin, I want to give you guys an overview of what we'll be discussing in our presentation. We're going to start with the EIC analysis, which I will be covering. We're going to go to the historical analysis, then transition to the multiples, and then finish up with our evaluation of KBR.
You can minimize that one if you're on. Yeah, it's like over there in the corner.
Okay.
Doesn't see it.
So KBR is formerly known as Kellogg's Group. It's an American engineering, procurement, construction company. It's headquartered in Houston, Texas. And so we found that KBR has a raw rate of 1.829. As previously stated, that means that as the economy moves at 1%, KBR also moves at 1.829%, as well as in contrast, if the economy decreases by 1%, KBR will decrease by 1.829%, implying that KBR is very economically sensitive, it's high risk and very volatile. Now we're going to focus on the quarters 5 forces analysis. As you can see, the buyer power currently is medium, supply power is medium, substitutes is low, entry or exit barriers is high, rivalry is medium. Overall, we thought that it was medium. So focusing on the buyer power, is currently, as I just stated, medium. We predict that it will increase in the coming years due to new drilling technology fueling of a rush of new projects for this industry. The supplier power is medium. It's in direct correlation to the buyer power because this industry owns a good percentage of the market, and so there's high supplier power, which knocks out other competition. Moving on to the substitutes, there aren't really any real substitutes in this industry because this industry has a specialized service. They offer services and products that are very specialized, so it's hard for other firms to come in. And this ties into the entry and exit barriers. It's very high. This is due to the medium and large scale companies because they kind of team up with each other and form strategic alliances that allow them to combine their resources and spread the risk amongst themselves. And then the rivalry, it's hard to, as I previously stated, to come into this industry. So because this is a complex industry and requires a substantial amount of capability, it's hard for other companies to come in and, I guess, make their claim in this industry. So this company specifically is focused on KBR, said the industry. They really don't have any competitive advantage. So the industry, as you can see from this table, RSC is 11.60, their WACC is 10.66, and they have a positive spread of 1.54%. And KBR has RSC of 8.54%. WACC has KBR has a WACC of 11.44%, and their spread is negative. So that shows that they are underperforming relative to their competitors. And so the question that we're going to be addressing throughout this presentation is whether the industry is doing bad. Whether KBR is doing relatively bad to its competitors because the industry is not doing well, or it's because KBR is actually doing well compared to the industry, and we can't see that because the industry is doing poorly. So now we're going to pass it off to Sarah. She's going to lead you guys into the RSC.
Okay, so this is our RSC super tree. On the top row of each little table is KBR, and then we have 5 of its competitors after that, and then we have the industry average after. So the first thing is the ROIC has 3 drivers that possibly affect it. So the first driver is the cash tax rate, and to very simplify it, pretty much if you think about it, if the tax rate increases, then you have more of your money taken away. So when the tax rate increases, the ROIC should decrease. And this held true in fiscal year 2011 for KBR, but not in 2013 and 2009. So I didn't believe that it was one of the factors that affected EOY ROIC. The second thing that affects the ROIC is the operating margin, which is calculated by dividing the operating income by the revenue. This, to simplify it, is pretty much how much a company makes per dollar of revenue. So if the operating margin increases, the ROIC should increase as well. This holds true for all years except for fiscal year 2013, when the operating margin, if you see in the very last column, in the operating margin for KBR, the operating margin then was the greatest for the 5-year time span, but the ROIC for KBR in fiscal year 2013 was the least. And the third factor that affects ROIC is the productivity, which is calculated by dividing invested capital by sales. And this has an equal effect on ROIC as operating margin. And when pretty much if a company can spend less to generate $1 of revenue, the ROIC will increase. And this is reflected in 2013 and 2012, but not from 2009 to 2011. So even though none of the three factors like corresponded for all 5 years, I feel like the operating margin is what affects the EOY ROIC the most. In terms of the industry, if you look at the last line, we calculated the industry average by weighting each competitor by how much of the market share they took up. And it doesn't seem that there's a particular correlation between any of the three determinants, and I believe that this is because each company actually has a different, they have different clients. For example, KBR, their clients are mostly the U.S. government, and since the government has been slowly pulling out of the Middle East, their services are needed less, whereas a company like AECOM, they serve the U.S. government as well as having international clients across multiple continents, so that's why they are more in demand. And this is our CFI statement, and you can see in 2014, the CFI drastically, the CFI starts to decrease. So I believe this is because from 2013 to 2014, the NOPAT/NOPLAT decreases, and then this causes the gross cash flow to decrease as well. And then from, 2013 to 2014, the free cash flow, excluding goodwill, also drastically decreases, which affects the free cash flow because that ends up decreasing as well. And then things such as the excess cash and let me see what this is. This is the increase in net non-operating assets and liabilities causes the cash flow available to investors to decrease throughout the rest of the years.
So I'm going to cover the multiples analysis. This is a Excel sheet with several multiples we use to compare our company and our other peers. We're going to focus on two multiples, primarily EV to sales and EV to EBIT. Beginning with EV to sales, the company that has the lowest margins tend to have the lowest multiple, and companies with the highest margins tend to have the highest multiples. This is generally true about 6 companies with one exception. Boyd Gas had the lowest margins, but it had the highest multiple. And to understand why, you have to calculate EV to sales in a slightly different way, which would be margins times your EV to EBIT multiple. And with that multiple, Boyd Gas had the highest multiple, which I will cover in the next section. So that's why they had low margins but a very high multiple. With that one exception, the companies with the lowest margins did have the lowest multiples. And KBR, our firm, had the lowest margins at 5.05%, and they had the lowest multiple at 0.28. Chicago Bridge and Iron had the highest margins at 7.74%, and accordingly, they had the highest multiple at 0.57. Next, I'll be going over the EV to EBIT multiples. With this multiple, you'll use a key value driver formula. With this formula, you can calculate the value of a company. If you manipulate it, you can use the components used to calculate a value such as growth, tax rate, WACC, and ROIC determined why companies trade at a premium or discount and calculate the EV to EBIT multiple using that way. The firm with the highest multiple was actually Boyd Guest, as I explained in the previous slide. This was primarily because of management decisions with their capital structure. So they were able to benefit from a very low WACC at 7.2% compared to an industry weighted average cost of capital using market capitalization at 9.2%. They only had a spread of 1%, so it wasn't really a story about them having any real competitive advantages. The company with the lowest multiples was basically a tie between KBR and AECOM. This was primarily because AECOM and KBR were expected to experience negative growth rates at negative 8.2% and negative 5.23% respectively. With AECOM having a slightly higher multiple because it wasn't expected to have a growth rate as low as KBR, and they also had a very high, actually the highest spread, which was 17% of all the 6 firms.
So I'll talk about the as-is valuation and then factors affecting our final valuation. So if you look over here, we found a revenue growth rate of negative 8.2% for KBR. This was found through the multiples analysis, and we wanted to keep it in line with the growth rate that we calculated based on a tax rate of 27.7% and a WACC, as stated before, of 11.44%. As well, we came up with an EBITDA margin of 5.95%. This was also taken from the multiples analysis, where we calculated an EBIT margin of 5.05%, and then we added back depreciation of 0.9% to come up with our final EBITDA margin as shown here. And we kept both of these numbers constant throughout the model. And then finally, we calculated a tax rate of 27.7%. We did not perceive any regulatory changes in the industry to affect the tax rate in any significant way in the future. Therefore, we kept that constant as well for our company. There we go. And once we attained our as-is valuation, we moved right into looking at factors that affected our final assumptions. We felt that these were the 4 main factors that affected the story behind KBR's growth and projected decrease in profit margins, which we'll talk about later. The first is revenue segmentation. This was looked at through geographic segmentation as well as service segmentation. We also looked at industry trends, mainly in the gas and pipeline construction segment as well as the engineering services segment, which both accounted for 2/3 of KBR's revenue in 2013. We also looked at regulatory changes, since as Sarah stated before, we do a fair amount of business as well with the government. In fact, in 2013, 1/5 of our revenue was accounted for through government projects. And then finally, we'll talk about commodity prices, and that affects inputs to our service that we give to our customers, as well as what our customers produce, which affects their ability to use our services. So if you look here at the chart, we can see that 59% of our KBR's revenue in 2013 was accounted for in the U.S. and Asia. 33% of that, as shown here, was in the U.S., and then 26% was in Asia. So we mainly looked at factors affecting the United States and Asia mostly in our presentation. Mostly, as well, obviously here, since they account for more than half of our revenue. So these were the segments we really wanted to focus on. Moreover, gas monetization, engineering services, and government and infrastructure, as stated before, were very large portions of our revenue segment in 2013. The gas monetization and energy services were 2 segments found to be affected in both the U.S. and China, but the government and infrastructure portion was mostly just analyzed in the U.S. since almost all of that revenue was accounted for through U.S. government projects. And as we stated before, we'll talk about industry trends, commodity prices, and regulatory changes. So in relation to industry trends, according to IBISWorld, pipeline capacity and maintenance growth is expected to increase in the coming years, and that's linked to natural gas production in the United States, which is increasing, as we all know, due to fracking. As well, we perceive improved commercial construction and rising U.S. demand, which should lead to increases in our revenues. Also, helping our revenues is perceived increases in private investment.
So although the U.S. is curtailing its investment in these types of services, private investment could act as a substitution for that revenue. Also, industry revenue for engineering services in China is actually expected to increase 4.3% annualized into 2019, which should also help our revenues. There are some cons, though, in the industry. One is that U.S. government investment, although still prominent, is definitely not as prominent as it has been in the past due to U.S. federal budgeting strategy changes, and that's mostly related to budget deficit changes. So that we perceive that will actually result in decreased revenues from the government sector. There's also increasing costs of skilled laborers in our industry, and that's going to decrease our profit margins as those costs increase. And as well, IBIS World expressed the assumption that there should be an increasing prime rate into the future, which leads to higher borrowing costs for businesses investing in heavy engineering projects such as the ones we offer. Next, looking at commodity prices, increasing steel prices are going to greatly affect our business. They're projected to increase into 2019, and steel is a major input to our oil and pipeline segment, which obviously uses steel in many of the construction aspects. But as well, we looked at global oil and energy surpluses. According to IBIS World's Oil and Natural Gas Price Index, from 2014 to 2019, it's projected to have a compound growth of negative 2.2%. These decreases in energy prices will negatively affect our customers who rely on higher energy prices for their business operations. This is also affected by slowdown in Chinese demand due to economic contraction, which is to say that China is not demanding oil as rapidly as it used to, and there's also increases in surpluses as a result of OPEC and other world leaders manipulating oil prices. So we believe that this will have a negative impact on our margins. And then finally, regulatory changes are mainly referring to U.S. regulatory changes. So the Federal Energy Regulatory Commission has been increasingly requiring players in our industry to adhere to strict processes before and during projects, and this is increasing costs as a result, which will also decrease our profit margins. And finally, taxation and tariff reform policies will also have a negative impact on our profit margins going into the future. So based on all of that information, we projected revenue growth modestly at 2%, increasing each year into 2024, and we kept that constant. However, our EBITDA margin, although lower than our revenue growth, actually increased from 2017 to 2024, which is to say that although our revenues are staying constant, based on higher costs as stated before and other factors, we believe that our costs will increase. Our costs will increase, therefore lowering our profit margins as a result. And as well as stated before, we didn't perceive any regulatory changes affecting the tax rate, so we kept our tax rate constant at 27.7% going into 2024. And this came out with a forecasted, in doing so, we came out with a forecasted share price of $18.90 compared to an actual share price on December 5th of $16.90. Therefore, we give a buy recommendation for KBR. This is also the ROIC chart, and as stated before, over time, industries with higher ROICs are projected to revert to the industry mean, and this is true for our company as well. And as you can see from 2016 going into 2024, we have a nice downward sloping ROIC, which will catch up to our WACC in the future. Any questions?
Yeah, so you're valuing the company a little bit higher than it's selling in the market right now. The beta is extremely high. Why is it a buy? I feel like I'm missing something. It's a high risk given its volatility, and you're valuing it not much higher than it's currently worth, and then you call it a buy.
Well, as stated before, there are perceived increases, that 4.4% increase in the energy services. Go back to your, oh, sorry.
Be easier.
This slide? Okay, yeah, sorry about that. Well, we do still perceive, although demand is decreasing in China, specifically in the engineering services segment, we do perceive that 4.4% increase to help our revenues into the future. And although they do have a high beta, we perceive the overall market consensus to be bullish in the future, and therefore we're holding our recommendation at a buy. I suppose if some sort of catastrophic factor negatively impacted the market, then that could really impact our model, but we perceive bullishness into the future, and that's why we're holding it a buy.
And if I could just add a little color commentary to his comments, the difference on this slide between the 1690 and the 1890 was the 1690 is the price in the market on December 5th. The 1890 is what they think the cash flow value of the company is worth. And what they did when they did their as-is valuation is to get down to the 1690 price, they were pretty much saying the market has some very negative expectations, particularly for growth, for KBR. And I guess the way they've come up with their buy recommendations to help them answer the question is they're basically saying it's going to be bad, just they don't think it's going to be as bad as what the market says it's going to be. And so therefore the market's probably overly penalizing them in the short term. So I guess that's the reason for the buy. So it's not like they're optimistic about the future. It's they're less pessimistic than the current case seems to be in the marketplace. If that helps answer your question.
Thank you.
Okay, great. In the interest of time, thank you, KBR team. Let's go ahead and do floor next. So floor, with the floor lead. You guys go. Floor? Yes. Floor's up. And then JEC. So floor and then John's. You can send you. They chop it. Take us a chance. And log in. Sure. You want to So if you look at this video, from about halfway through each of the screens is what they're seeing. So you actually have room more.
KBR long term.
All right, great.
MBA class. I don't sure.
Yeah.
Yes, MBA.
Interesting.
So this is the this is what they're seeing right there. The rest
This is what.
This one too.
You know, it's interesting. You look at the YC charts of past and all that. But it's tough to predict when it's going to happen. That's like the illusion of pending stability. Optimism.
All right, so we're going to go through floor next, and
Floor.
we go. All right, are you seeing the floor PowerPoint?
Yes. Yep.
Here.
Okay, hello, my name is Mary, and Brian, Jack, and I will be presenting our evaluation of Fluor Corporation. Fluor is a Fortune 500 company that is a leader in construction, engineering, and procurement services. It is a conglomerate and has projects in the fields of chemicals, energy, and industrial infrastructures, among other things. Fluor is currently based in Irving, Texas, and trades on the New York Stock Exchange under the ticker symbol FLR. As of 4 p.m., Fluor's share price is valued at $59.89 by the market. Okay. First, we're going to begin with an EIC analysis to get an idea of the environment Fluor operates in and some insight into the construction industry. Okay, here is the raw 5-year beta for Fluor. Its peers in the industry-weighted average. Fluor's beta is 1.57 and the industry's beta is 1.37. Both of these are relatively high, so we can infer that the construction industry is volatile. And this isn't surprising if you look at the historical financial statements of most construction firms. The standard deviation of Fluor's annual revenues is about $2.6 billion. Meanwhile, Coca-Cola's annual revenues standard deviation is about $650 million. The reason why construction has such volatile revenues is because there's a lot of uncertainty about whether a construction firm can win a construction contract with the major oil drillers and manufacturing firms in any given year. Furthermore, these firms don't consistently demand construction services, so there's a lot of uncertainty about a construction firm's income. Here are the spreads for this industry. Fluor's spread is one of the highest at a value of 7.48%. CBI has a higher spread of 7.58%, but that's because their capital structure contains a lot more debt than Fluor and the peers, and they're protected by the tax shield created by debt. So that's a bit convoluted. Regardless, Fluor has a competitive advantage since their spread is greater than the industry average of 6.06%. However, the industry average may also be a bit biased by the foreign peers we're using, Bouygues, which is French, and CTCI, which is Taiwanese. Both of these firms have operations that are very similar to Fluor, but the different tax rates and interest rates in France and Taiwan may convolute this weighted average. Here's a chart with the results of our 5 forces analysis. Some of the things here are pretty obvious. There are high barriers of entry because construction is a capital-intensive and logistically complex industry, which is good for Fluor because it protects the firms who are already in this industry. We already talked about the high buyer power when I discussed beta and volatility of revenues. Fluor's customers are mainly major oil drillers and manufacturing firms who can easily choose one construction company over another. Also, for this reason, there's a fair amount of rivalry in this industry. We thought it was necessary to discuss the recent trends in the oil industry in addition to our discussion of construction because 42% of Fluor's revenues come from constructing for oil and gas companies. So I'm going to do that now. Around 2008 and 2009, technological innovations made it possible to frack for oil per share. Starting in 2011, Western countries like Canada, the US, and the UK have noticeably begun increasing their production of oil. And since then, the overall world supply of oil has increased. Because of this, the world was expecting OPEC to cut their oil output by their oil output quota of 30 million barrels. But last week, OPEC made an announcement saying that they don't want to cut production, and in particular, Saudi Arabia does not want to cut production. This announcement means that the world supply of oil will only increase. It is very important to note that the demand for oil is not increasing fast enough as the supply of oil is increasing, so therefore, by the law of supply and demand, the price per barrel of oil will fall, which it did from $90 to $70 last week. This affects Fluor because falling oil prices make investment in the oil industry unattractive, and this can potentially harm the demand for construction services, which adds additional uncertainty to Fluor's already volatile revenues. However, it's ambiguous what will actually happen in the future. In the meantime, Fluor does have other earning opportunities. For instance, current oil and gas refineries are aging. And because of this, there's an increase in the demand for maintenance and repair services. Every few years, oil drillers and gas companies will have to contract firms like Fluor to ascertain whether or not their facilities are up to par and make any necessary repairs. This creates some stability for Fluor's revenues in the future. Another earning opportunity for Fluor are emerging markets. Other countries around the world are becoming wealthier, and these countries are investing more in themselves. Moreover, these countries are doing things like building factories and oil and gas refineries, if they can do that, and demanding construction services. This creates another earning opportunity for Fluor. Furthermore, Fluor is already contracting in Asia, Africa, and the Middle East since their revenues in these areas make up 29% of their total revenues, or $8.16 billion. Because of this, Fluor has a good chance of winning construction contracts in these areas in the future.
All right, so next I'm going to talk about a 5-year historical analysis of Fluor and its peers' financials, starting with the ROI Supertree. As you can see, Fluor's ROIC dropped from 72% in 2009 to 46.6% in 2013, while the industry dropped from 32.8% to 26.5% during the same time. These numbers make Fluor's decrease seem higher than the industry, but if you see the Bouygues, who is the one company that had an increased ROIC over this 5-year span, they had the largest market capitalization of any of the 6 peers. And when calculating our industry averages, we used a market capitalization average. So they had a high influence on our averages when Fluor was pretty much having the same decrease in ROIC that everybody else was. Next, we're going to talk about the drivers of the ROIC. First, the tax rate. Both Fluor and the industry saw decreased tax rates during this 5-year period. But since pre-tax ROIC and end-of-year ROIC also decreased during this time, we determined that tax rate wasn't a main driver of ROIC. In tax rate, you can actually see Bouygues' their influence on the industry again with their negative 130.6% 2013 tax rate, leading to a negative industry average for tax rate, where now Bouygues had a end-of-year pre-tax ROIC that was actually decreasing. We found that end-of-year pre-tax ROIC was a better, showed better how our end-of-year ROIC was driven. This can be shown through operating margin. From 2009 to 2013, Fluor and the industry's operating margins both decreased, starting at 5.1% each and falling to 4.4% and 4.3% respectively. Because these yearly increases and decreases in operating margin were reflected by the pre-tax ROIC for both Fluor and the industry, we found that operating margin was the main driver of our pre-tax ROIC. The other driver was productivity, which also saw an effect on pre-tax ROIC, yet it wasn't as severe as operating margin. Productivity decreased over these 5 years for both Fluor and the industry in the form of increased invested capital over sales. But the year-to-year trends weren't reflected in the pre-tax ROIC. So for instance, in 2013, Fluor saw their productivity decrease, yet their pre-tax ROIC increased due to an increasing operating margin, which had a higher weight on the pre-tax ROIC. If we look closer at their operating margin, we see that the gross margins also decreased over the 5-year span. This was probably because steel prices continue to rise over the last 5 years, and there's been an increased demand for skilled labor in the construction market, limiting the profits for Fluor and the industry. Over the same time, SG&A stayed the same for Fluor, but decreased significantly for the industry, and this again was because of Bouygues. They were the only one that had significant decrease in SG&A. So the market as a whole, they saw a pretty steady SG&A, and depreciation really didn't factor into the operating margin. Next was the productivity. So if we look at productivity, we see that PP&E over sales stayed the same for both the industry and Fluor for this 5-year span. Operating capital over sales was the one factor that increased over this time, which was the main driver of invested capital over sales, which, as we said, wasn't as big as a factor in the pre-tax ROIC as operating margin. Next, we're going to look at the industry CFI. So the industry as a whole saw a $38.6 billion gross cash flow with a free cash flow of $8.6 billion, allowing for a reinvestment rate of 35%. And as you see with Fluor and its peers for the gross cash flow, the numbers fluctuated year to year, and this is because we said of their high beta, it's a very volatile market. And after their 35% reinvestment rate, they were able to pay out, as an industry, $16.66 billion in dividends and buybacks. Now we're going to look at the cash flows available to investors by Fluor. Fluor had cash flows of $4.2 billion over this 5-year span, with investments of $1.9 billion, giving them a reinvestment rate of 45%. Similarly to the market, their gross cash flow fluctuated because of this volatility. From the $2.3 billion they had in free cash flow, increases in net operating assets and excess cash led to cash flows available to investors of $1.8 billion. And from this, they were able to invest $375 million in debt and pay back over $2 billion in dividends and buybacks.
We did a multiples analysis, and the most enlightening multiples were the enterprise value to next year's EBIT, and the enterprise value to next year's sales multiples. Our conclusion for both of these multiples was that Fluor is undervalued. This is largely because Fluor has the highest ROIC of its peers at a value of 55.1% compared to the industry average of 29.48%. Furthermore, since Fluor currently has one of the highest spreads in the industry, we can infer that Fluor is doing a better job at creating value than most of its competitors. Fluor's growth rate, WACC, and tax rates were all near the average, so it didn't really add much to report from here. Fluor's high ROIC is really what drives down the EV to EBIT multiple. Here, Fluor is the lowest of its peer at a value of 0.35. The industry average is 0.47. This implies that, considering Fluor's EBIT, their enterprise value should be higher, but it's not, so Fluor is undervalued. The EV to next year's sales multiple has a similar analysis and conclusion. Here, to be pedantic, we reported the operating margin, but it really isn't that enlightening because the Fluor's operating margin of 4.99% is similar to the average of 4.68%. Again, Fluor is the lowest of its peers in this multiple. This is because Fluor's high ROIC, again, drives down the EV to EBIT multiple, and that drives down the EV to sales multiple. Again, this is
I think it's a typo. You got it backwards. EV to sales should be the column on the right. EV to EBIT should be the column on the left. There's a typo on the slide. Those watching, EV to sales is actually the middle column. EV to EBIT is the column on the left.
This is our EV to EBIT.
Yeah, maybe you should just go after that one. It got screwed up on this.
Okay, sorry.
Go to the next slide. Or back a slide.
Okay. Well, again, this implies the enterprise value should be higher considering Fluor sales, but it isn't, so Fluor is undervalued.
That's EV to sales, by the way. The previous one, we say EV to EBIT, that's EV to sales. You said your title's wrong.
Sorry.
All right, so now we're going to talk about the valuation of Fluor. As model, revenue growth rate of 2.68%, which was taken from our multiple analysis. We're comfortable using that number going forward, as it is fairly similar to the industry average of about 3%. To get our EBITDA, we took our estimated EBIT from our multiples analysis, which was 4.99%, and we added depreciation and amortization to give us EBITDA of 5.7%. For the tax rate, we came up with 28.9 by taking the mean of our previous tax years from 2008 to 2013. As there were no statistical outliers, we were comfortable with taking the mean from those years and using that number going forward. So we recommend to buy floor as our expected price of $73.09 is significantly higher than the current price at around $60. We believe that the key trends that Mary mentioned in the industry overpower the volatility in the industry, which requires rates to increase. Compared to the as-is, revenue growth rates are higher in more recent years, especially 2015, and that's due to increase in industrial investments, which kind of signifies the U.S. recovering after the recession. I will talk about the slightly lower growth rates from 2016, 2018 really quickly. We think that the industry is kind of going to stall a little bit as it relates to the recent OPEC announcements and the price of oil dropping. However, we expect that to pick back up in 2009, and that's why we have a continued growth rate of 4% moving forward. The CV growth rate of 4% is, we expect it to be attributed to demand for construction services to increase, as well as investments in natural gas are expected to grow. Moving on to the EBITDA. In regards to the EBITDA, we expect the margins to fall each year by about 50 basis points for about two reasons. The first being that the world price of raw materials such as steel is expected to increase. It's tough to determine how much, so that's why we only are decreasing it by about 50 basis points. Secondly, the cost of skilled labor is expected to rise as well, slightly decreasing margins. And as I mentioned before, the tax rate is just the average of the previous years as there were no outliers. Again, we would buy the stock as we feel that it's undervalued. Some of the assumptions we made, as I mentioned, the assumed revenues will slow between 2016 and 2018, and then assumed CV rate growth rate of 4%, and the margins will fall slightly because of a rising cost of labor and rise in raw materials. Here you can see our forecasted ROIC. The ROIC is compressing towards the WACC in the long term, which further supports our model. Even though that decreases margins slightly, we feel that the key trends will ultimately cause an increase in Fluor's revenue as well as its stock price.
Thank you very much. I was going to ask if there was a question from Connecticut, but I just wanted to make an observation. Basically, what we're seeing here is with Fluor as much more of a prime contractor that also has diversified client base across multiple segments, is actually trading at a buy, is what they're saying, and trading at a much better stock valuation than somebody like a Granite, who is a commoditized, much lower margin business that is relying very heavily on one segment. And I think that's the major financial differentiator between the two companies, where Fluor is looked at very profitably as a prime. Again, you're looking at 5 to 6% margins versus 2 to 3% margins. Well, Granite happens to be losing money this year. So they're getting that premium, and their diversified portfolio in oil, gas, outside of just construction, is actually really helping them, as well as having the global perspective. The global footprint is helping them as well, where Granite is much more of a U.S. footprint. So it's just interesting to see that the market really is valuing the companies that have the global footprint, that have the prime place in the marketplace, that have the higher margins, that have multiple product lines at a much higher valuation than the commoditized, single, Granite-like company that doesn't really have a global presence and is really suffering in the roads and construction market. So I think you're seeing that level of contrast between those two presentations. But I just let the lay people ask any questions before we go to the next group. Does that make sense?
Yeah, see some parallels to us.
Wasn't saying that exactly, but we could draw some conclusions there. All right, thank you, Fluor. Jacobs had to go, so Jacobs will be next.
Yeah, and Joe, I think I told you that not everybody can make it here to the end.
Understand. Thank you. Thank you for those that had to go. Jacobs, how is your go ahead and log in? Are you going to go into IE or? Well, did you take your thumb drive back, or?
I wish they did.
No, but just having that diversity, hit, you know, try and go a certain way, your entire company won't go in that direction necessarily.
Whoever
smooths it out.
You heard of some company that explored or winning one of these like into their market when it's about election, it's so many different.
Yeah, they've diversified so much. Yeah.
Generalized.
Yeah.
One set of numbers when it's then that number.
make sure. I'm just double check to see if it's still displaying. Okay. We'll the screen sharing here.
Do one on both. Yeah. Right there.
All right, are you seeing the Jacobs presentation?
Yeah.
Okay, great. All right. Jacobs, you're up. Again, you go from about middle of the screen to middle of the screen. Or what the camera's going to see.
Good evening. We are representing Jacobs Engineering Group Inc. JEC is the ticker for this. My name is Ashmi Shah.
I feel so. I'm Matthew Burrows.
And today we will be your presenters. So really, I'm going to cover JEC's EIC as the industry attractive. So I'd like to start off just by a brief discussion of the engineering services industry, which you can clearly see the overall raw beta is 1.50 and JEC's raw beta is 1.39, suggesting that the observed relationship between the securities return and the returns of the index for the industry and company is more volatile than the market. So the betas indicate that securities price for JEC will be 39% more volatile than the market. The average will be 50% more volatile than the market. Relative to the I, the industry performance, using our model, we determined that the industry's 2013 ROIC is about 16.3%, and the 2013 industry's cost of capital is about 9.8%. Our model has a larger spread than that of Bloomberg data, but it does not include the non-operating data, and even though the industry is achieving a positive spread, it is average in regards to attractiveness. So over the last 5 years, the industry average EOY ROIC has gone down by negative 45.6%, and you can see this on the ROIC and spread tree. This decline has come because of higher than average EOY ROICs of Fluor and FWLT, which then declined substantially by 2013. So for FLR 2009, the ROIC was 50.1%, and it went down to 35.7%, whereas for FWLT, ROIC was 70.9%, but was in 2013 23.5%. So when looking at Porter's 5 forces, it's important to focus on the forces that will change in the next 5 years. The industry is beginning to consolidate more, which will cause a decrease in rivalry. While the industry used to be dependent on government contracts, the number of these are decreasing because of future sequestration in the government. Thus, private investment will increase. The barrier to entry, we predict, will also increase because these consolidated companies will have more market share, resources, and other capabilities. Growth is expected to be strongest in 2016 because of an emphasis on green building and computer-aided design systems that provide cost-effective project assessment. We don't see JEC having significant competitive advantage because it has similar spread compared to most of the other companies in the industry. The company has an ROIC of 60.3 and a WACC of 9.8, giving it a spread of 6.5%. So JEC is performing at around the industry average return. We think that it may improve, but not dramatically in the future, because while JEC has benefited from recent acquisitions in the federal network systems and other companies like Eagleton Engineering, and other smaller firms with niche focuses, JEC may become more competitive, but we don't really see a dramatic change in their competitive position.
So to look at the industry from a historical perspective, we see the 5-year ROIC tree, and the ROIC has decreased from 30% to around 16% for the entire industry. And this is when the tax rate is relatively constant at 30%. So this decrease in ROIC can be attributed to a decrease in margin and a decrease in efficiency, which is represented by invested capital over sales. So on the left is the tree for the components of operating margin, which is gross margin, SG&A costs, and depreciation. And we can see that the decrease in operating margin is due to a decrease in gross margin and an increase in SG&A costs for the industry over a 5-year period by around 1 cent on the dollar, while depreciation has remained relatively constant and insignificant. So on the other hand, for efficiency, the industry has seen a decrease in efficiency in working capital over sales and intangible over sales, because the industry has been going through a phase of mergers and acquisitions, and these have been getting more and more expensive relative to their sales, and they're increasing their working capital. But this is somewhat offset by a 1% decrease in their PP&E per sales costs, but this still results in an overall decrease in efficiency. So looking at JEC's cash flow statement, we can see that JEC's cash flow available to investors has decreased over the 5-year period, being particularly negative in the middle 3 years due to an increase in 2010 and 2011 in non-operating assets, but then an increase in investment in goodwill intangibles due to a merger with Acker company, which they bought partially. They bought shares in 2010, and then they bought the entire unit in 2011. And this is also met with an increase in gross investments in 2010, 2011, and 2013. They're increasing their capital expenditures and increasing their working capital as a preparation for growth in the future, which has been quite slow directly after the Great Recession, but they're expecting it to pick up. So they're currently withholding their money from their investors to prepare for the growth in the future. And so we see this on the other side of the equation. They're increasing their debt liabilities and withholding retirement liabilities to finance these investments within their company. So continuing on to the multiples. So this is a table of the multiples of our comparables, and the key ones I want to focus on are EV to sales and enterprise value to next year's EBIT. EV to sales is a representation of both margin and its equation uses both. It's a multiplication of operating margin and EV to EBIT. So the result you see there is a combination of both. So by multiplying those two numbers together, you get an operating margin, which is relatively similar for the industry, while diversification and more heavy. All these are combinations of engineering and construction companies. So engineering is more profitable So the more engineering they have, the higher margin they have, and the more diversification they have, the more profit margin they have. So so the ranking of the EV to sales is doesn't really reflect this constant operating margin. As you can see, they're all over the place. But this is because of the EV to EBIT, which is a combination of WACC, ROIC, and growth. And our company, Jacobs Engineering, has average ROIC, and taking into account their average WACC and their slightly above average growth, they rank third within EV to EBIT, while Foster Wheeler ranks the highest in this category due to their extremely high ROIC and their comparable growth to Jacobs. Also, there's the price to book ratio, which shows the price to earnings ratio. The price to earnings ratio, which shows the same results as EV to EBIT, except it also reveals the capital structure of the company. So KBR has taken on a lot of debt to inflate their PE in comparison to their position within EV to EBIT. So their PEG ratio is also an indication of what investors are willing to pay for percent of growth in the company, and it's really just a representation of investor confidence in this company and how old this company is, because and it just shows that Fluor out of this industry has the most confidence within its operations.
Thanks, Felix. We're now going to move on to the valuation portion of the presentation. We're going to start off with the as-is presentation, which is the way the market currently is evaluating the company, and then we will move on to our final valuation of the company and where we think the share price should be at. So as of Thursday, December 4th, JEC closed at $46.30. These are the assumptions that the market has currently built in to that price. The margin of 5.7% we learned from the multiples analysis, and an EBITDA to sales of 6.5%. Now, to reach the close price of $46.30, we actually slowly decreased the margin of 5.7% all the way down to 4.9%, and that was done by decreasing the EBITDA to sales to 5.7%, which you can see here for 2014 and 2015, we used the Bloomberg consensus estimates. And then in 2016, that's when we started slowly decreasing the growth rate down to 3.7% ending in 2022. And the EBITDA, we kept at 6.5%, which we learned in our multiples analysis. And then we slowly decreased it to 5.7%. The tax rate, we used the average of the previous years at 35.3%. Because we felt that was a pretty good representation and there wasn't any huge outliers between those years. And as I said earlier, the 2014 and 2015 revenue and EBITDA was the Bloomberg consensus estimates. Long-term growth rate, in perpetuity, we used a 3.7% growth rate, and we learned that in our multiples analysis as well. And the weighted average cost of capital for JEC is 9.8%. So this gave us an as-is forecasted share price of $46.51. In our final valuation of Jacobs Engineering, we changed a few assumptions. We had a decreasing EBITDA margin, the same as in the as-is, but not decreasing as much as the as-is valuation. And we also used a lower perpetuity growth rate for Jacobs Engineering. Our final valuation forecasted share price was $47.56. The margin of 5.7% decreased only to 5.2%
versus much lower in the as-is valuation. The EBITDA to sales started off at 6.5% and decreased to 6%. Now, we felt that it was going to be decreasing as there was going to be less government spending in the future as of sequestration, and private investment would pick up some to help with that. The tax rate we left at 35.3%, and although Jacobs Engineering is a global company and they've actually acquired other companies recently, unless they acquire a company where they can possibly get a different tax advantage with it, they're going to remain at around 35% tax rate. For our perpetuity growth rate, we use 2.5%, and our reasoning here, instead of a 3.7%, we didn't feel that the economy was going to be growing that fast long term, and we actually assumed that the economy would be growing much slower at about 1.5%. So we chose a 2.5% perpetuity growth rate because we feel that the company will actually grow faster than the economy because of the aging infrastructure in the company, and the need for replacement can actually cause more growth than the actual economy. Here's ratios of what I just talked about of the Bloomberg consensus in 2014 and 2015, and then the growth rate decreasing to 3% in 2022, and then the perpetuity growth rate picks up after that. And the EBITDA margin of 6.5% starting in 2016, decreasing to 6% in 2022. And our operating margin of 5.7% starting in 2016 and decreasing to 5.2% in 2022. This is our expected ROIC chart. And as you can see, it starts off, it increases a little bit, but also decreases after a few years when the EBITDA margin starts to decrease. And we feel this is a pretty good representation of the future for Jacobs Engineering, especially with the theory of ROIC decay and gaining closer to the weighted average cost of capital in the long term. So as of right now, we have a hold recommendation for Jacobs Engineering because our final valuation was to hold JEC as our forecasted share price is $47.56, which is only about a little more than $1 above its close on Thursday. One of the things that we noticed was that when we originally did our valuation 2 weeks ago, their share price was actually $1 greater than $47.56. And we actually think that drop recently has been because their CEO and president said he was going to resign within the next month or so. So that's actually the main reason for the recent drop in their share price. Okay. Any questions?
Questions from Connecticut?
I think we're good, Joe.
Okay.
Thank you so much for your time.
Yes, thank you as well. Thank you. You? Quanta? All right, so Quanta will be next. So again, just kind of continuing with the theme as Quanta gets their presentation up, I think you can see that we can put almost Fluor and Jacobs in a group together, that it's the higher end primes and or construction engineering services that are getting both better margins in the market and are trading at premiums in terms of their stock price. So, and it was a reference that I did make, Mike, to kind of the position of Lane, which is your aspirational goal of going into the P3 market very much starts to look at margins more like a Jacobs or a Fluor. All right, so we're just switching out. Quanta up. So we're down to the final two presentations.
Just P3, another arena. But I look back there. Could smooth things out.
Once we get a good cycle,
Yeah, I was looking at some data on that. There are far more P3s in Europe than over here, like way more. It's almost, yeah.
Oh, yeah.
All right, so we're going to try and share. Which one is this? So, work on one?
Yeah.
Did you put it in regular PowerPoint?
Yeah. I think I can tell, but I don't know. It's not there.
Let's try that. It's not this one?
No.
Can you go back? The left? This one? It's that one?
Yes. I'll download that one. There you go.
All right, so we'll put this here. View.
Okay, you got it.
I want to close that one. There we go. All right, are you seeing the Quanta?
Not yet.
No.
How about now?
Yes.
Okay, great. Hide this down here. Okay.
Good afternoon, ladies and gentlemen. We're at Quanta. My name is Joel Cox.
I'm Casey. I'm Chloe.
Right off the bat, we're going to issue a buy with a target price of $39.60. At a current stock price of $30.02, that's an increase of 30%. Our main reasons we'll be discussing throughout our presentations are the economic conditions despite the recent downtick in oil, higher projected continued growth than the industry average, also crumbling infrastructure in the United States that needs to be addressed. Congress knows that. Potential in exploiting shale formations in Canada and the Midwest. High margins and productivity are going to be the key drivers. Chloe's going to take us through a quick background on the EIC.
So we're going to start with just a quick overview of Quanta and the services that they provide. So they were founded in 1997. They're not an entirely super old company, but they have been around since then. They're headquartered in Houston, Texas, and they operate mainly in the electric power, oil, and natural gas infrastructure industry. So transmission line construction, sort of getting these resources to these companies when they need them, and sort of in that planning and infrastructure industry. However, it should be noted that 2/3 of their revenue comes from that electric power infrastructure industry. So we've chosen to focus on that industry primarily when we are looking at a 5 forces analysis. So we projected a 5 forces analysis of the transmission line construction, infrastructure, and planning industry within the electricity industry with a current forecast and a 5-year forecast for later. So perhaps the biggest thing to note for the current forecast is that competition in this industry is extremely high. Quanta is the market leader in this transmission line construction infrastructure industry, and they still only have a 6.4% market share. So we have companies that are serving both the public, the private clients that are large and small that are all competing in this industry, making competition very high. Going off of that, the barriers to entry are moderate because of this. Surprisingly, even though it is quite a technical industry, it isn't the startup cost or the capital needed to enter the industry that bars people from coming in, as the equipment can be leased. It's rather that high competition. So having all of these people, all of these competitors, corporations that already have established reputations in the industry really makes it hard for people to sort of break into the industry. Going off of this, buyer bargaining power is very high. Again, the competition is fierce. It works as sort of a competitive bidding process. So these are very high contract, high profit contracts. So usually they will submit proposals to these government agencies or large corporations that need infrastructure planning for electricity or power. And it drives profits down. People are competing for these contracts, and it really gives the buyers a large amount of power. Substitutes and sellers' bargaining power are relatively low. There's not many valid substitutes within the industry. The only sort of concrete substitute is if firms have already hired in-house help. So they have infrastructure planning engineers already within their firm that might take away some of the profits from the full package of services that can be provided. And again, sellers' bargaining power is low as their equipment is largely leased and costs are relatively flat. However, future forecast, things are changing. So this industry is going to be evolving as we see government clients and corporate clients moving towards green energy, fiber optics, high-speed data. They need that new infrastructure. There's going to be new technological innovations within this industry. So we can see the competition is still going to be high and it's going to be increasing. We have more demand. We have more people that are willing to enter this field and try and sort of break into this market with this new demand. Again, the threat of the barriers to entry are moderate. People will still be trying to enter, but the competition is already high. People have, corporations already have established reputations, and they're going to have to be dealing with that. Substitutes will remain low, and buyer power will still remain high to moderate. Because we're moving towards a more technical sort of field with these new technological innovations, it will decrease buyer power a little bit because they will need more sort of specialized companies that will be able to provide these services. But again, with the demand rising, competition will be high. So again, this is just a brief overview of the things that we project to see changing. Competition high, and buyer power sort of decreasing a bit, but other things remaining relatively flat. So just looking at a snapshot of the industry outlook, it is attractive. We see growth and innovation happening in this industry with this push towards technology, green energy, renewable resources, smart grid technology. They need these infrastructure planning and resources that Quanta can provide. What's interesting to note is that the infrastructure itself and the services aren't changing, but the services are needed. So with these new technologies, they aren't needing entirely new services. They are still needing those old services and expertise that Quanta provides, but they're needing it in a larger quantity than they did before. As we see the government sort of coming out of this recession, this demand is going to rise. They're going to have more buyer power, and Quanta's current position as a market leader sets them up favorably in this industry.
So looking at the beta of Quanta and its industry, the industry average beta is 1.41, meaning it is pretty sensitive to changes in the economy. However, Quanta's beta is a lot less sensitive than the industry average at a beta of only 1.08. And looking at the economic conditions and seasonality, Quanta faces a lot of challenges with weather, customer spending patterns, bidding seasons, and project timing, and this all affects the revenues and the operations. Traditionally, revenues are the lowest in the first quarter because the weather is particularly bad during this time, and companies are still building their budgets for the year, so they haven't really decided to take on projects yet during the first quarter. As it comes to the second quarter, it is a little higher than the first quarter because the weather is slightly improving, but it's still pretty bad, and companies are finally starting to finish their budgets and, take on projects. The third quarter sees the highest amount of revenue and operations because the weather has finally calmed down and has created prime working conditions. Additionally, the budgets are finished and the projects have completely started by then. In the fourth quarter, revenue is lower than the third, but still slightly higher than the second because, projects are in their final stage. However, holidays come about and the weather starts to turn poor. Quanta believes that expansion to foreign operations in countries such as Canada and Australia will cause a lessening pattern affecting the quarterly revenues to make it a little bit more even. In addition, that Quanta operates in a very highly cyclical industry. Continuing on with that, Quanta's industry is very regulated and has a lot of environmental regulations that cause them to really have to monitor their day-to-day operations. As they're so affected by the economy, they're seeing only gradual recovery from recessionary levels in the economy. As of now and projected for the future, oil and the gas market will be the primary profit driver and area of new work. In North America, exploration and production companies investing a lot of money into exploring shale formations, which will give Quanta new work in the future. Additionally, recent and perhaps most helpful to Quanta is that studies have shown that fracking
it's not quite as bad as they think it is, and if the wells are properly input, there will be no water contamination. So that has really helped change the perspective of the population and their thoughts on fracking.
So we do believe that Quanta Services has a competitive advantage. Where does it come from? It comes mostly from its high profit margin, its low revenue volatility, which we'll get into further on. Newly elected Congress, we believe, will probably spend much more money on energy infrastructure. Analysts additionally project Quanta growing faster than its competitors. A good example of this is not this. Good example of this, just recently, about 3 weeks ago, Quanta purchased Bannister Pipelines on November 24th. It's a Canadian pipeline construction and maintenance company with projected 2015 revenues of $350 million. The details of the deal weren't disclosed. However, it's really important to note here that it's one of the 20 of the largest pipeline prospects in North America. Will likely account for about $73 billion in spending during the next 5 years, and 70% of that is Canadian. And that doesn't even include the Keystone Pipeline projects that are lined up. We do think that those will happen, though. Getting into their ROIC, as you can see, ROIC is down for the industry from 40 to 21%. Despite that, Quanta Services is up 6.1 to 8.9%. That's not because of the cash tax rate, which is up for the industry. Reflecting that, obviously, the pre-tax ROIC was slightly higher. We feel that the ROIC was probably driven by their productivity, which was up about 30% for Quanta and 12% for the industry. Operating margin was down for the industry by about 6%. Quanta Services, again, bucking the trend, up by about a penny. Looking at the gross cash flows for the industry were pretty steady over the last 5 years. For Quanta Services, they were pretty steady from 2009 to 2011, then increasing slightly in 2012 and 2013. This increase comes mostly from sales of unprofitable segments. In 2013, Quanta sold its domestic telecommunications infrastructure services for $265 million to Dycom Industries. This 265 is net of cash and stock. Free cash flow saw dramatic improvements for the industry, up from $8 million to $1.2 billion for the industry. From no help from Quanta's, however, which is negative in all but 2 years. Quanta uses the positive free cash flow to buy back shares. It doesn't issue any dividends. In fact, none of the peers do in the industry, and if they do, it's very, very little. This is reflected in the reinvestment rate of 57% for the industry. Quanta Service well above that at 93%. As we can see here in 2010, 11, and 12, they might have even borrowed a little to buy other companies. Paid it right back, though, because they don't have any debt in their capital structure today. Looking at their multiples, some of them pop out. Quanta Services leading the pack in terms of EV sales, trading at a 0.82, well above the market cap weighted average of 4.9. This is mainly driven by their high margin of 8.94, which gives them a competitive advantage. Also jumping off the page, Foster Wheeler trading at an EV/EBITDA of 8.34, well above the market average of 6.32. This is probably driven by its ROIC of 46.6. I will get to that high ROIC in a second. Also notable here is a low PE ratio, which is highly affected by capital structure. I will note here that Mastech and AECOM both have debt in their capital structure, short and long term. Mastech has 29%, AECOM has 22%. And I only bring that up because of the only two that actually have debt in their capital structure, while the other ones don't have any at all. Summarizing, EV sales from Quanta Services up pretty high, 8.2, driven by its industry-leading margin of 8.94%. AECOM, who recently bought URS, trading at a very low EV to EBITDA. They have a high ROIC, but we think it's offset by its negative growth rate of negative 11.92. Fluor, we talked about previously. Their 6.23 EV to EBITDA is below the market cap weighted average. Even though they have a high ROIC, we think that's offset by their risk. They have a high WACC, higher than the rest of their peers in the industry.
Foster Wheeler trading at 8.34, well above the market cap weighted average, mostly driven by their high ROIC of 46.6%. I do want to note here, though, that the ROICs that we are computing are these are forecasted ROICs and not ROICs that are based on the past. Also, a lot of times these ROICs, it really depends on how a company segments their firm. For example, IBM has among other segments, they have a financing segment, so that would show up as operating ROIC, and these are strictly ROICs, operating ROICs, sorry. Looking at their margin analysis, we thought this was interesting. Even though Quanta gets 70% of their revenue from electric power, their margins are inflated by fiber optic licensing. This is a very small segment of the company, but it has very high margins. They don't really see much potential for growth there. Where they see most of their growth is in the oil and gas infrastructure, which has very volatile margins. So they do a really good job of sort of evening that out by focusing on all three of these segments. We thought it would be interesting to see how Quanta's stock price responds or moves with an oil and gas index as well as an electric utility. And what we can see here is that they move in the same direction. However, Quanta, being the orange one, is a lot more sensitive to the price of oil. You can see that it just responds a lot more volatile than does electricity, for example. And oil and gas index is somewhere in between. At the same time, we tried to pull a relationship between Quanta and Lane Construction. We noticed that Lane Construction entered a contract with Gemma Power Systems as a joint venture to build the Panda Power Patriot Natural Gas Field Power Plant in Pennsylvania. I think this happened just in August. And we noticed that Lane wasn't a publicly traded company, so we tried to figure out how would Lane possibly respond and behave in the market if they were traded. And this is what we came up with. And you can see here that it sort of moves in a similar direction as Quanta does. Our assumptions for our final valuation are we think that the market assumes a 10% growth rate, which will taper off to something close to what the electric infrastructure growth rate is forecasted by IBISWorld, 0.5%. We think that our EBITDA is a little bit high. The market thinks it's about 12.5%. We think that Quanta is very sensitive to fluctuations in EBIT margin. And the tax rate we think probably won't change. We didn't see any reason to change it, just like the other groups didn't. Long-term growth, as mentioned, depreciation of 2.5%. For our final valuation, we focused on revenue growth. We think that's going to be a little bit higher. We also think that's going to continue on, and we think that's going to remain somewhere around 5%, which is higher than the which is a little bit faster than the economy. Just to sort of smooth things out, we think that the EBITDA is going to be a little bit lower, but still no reason to change the tax rate at all. So the long-term growth rate, somewhere around 5%, again, no change in depreciation. Plotting this on a graph, we think that the ROIC will settle somewhere around 14%, slightly higher than their WACC. Quanta will focus on earnings growth instead, and also we'll see some more spending in energy infrastructure, just like we saw in the margin analysis. Summary and keys, again, we think it's a strong buy. Target price $39.60. But we think just because we think Quanta is capable of growing without raising much debt, Congress recently approved a $10.8 billion measure for highways and bridge repairs, and we just think that this is an indicator that that Congress is willing to spend those necessary funds, and Quanta is positioning itself right now to take advantage of those circumstances. Our higher than market price target reflects the catalysts we expect from the midterm elections, so we think it's fairly priced too. Also, Quanta's board approved $500 million stock repurchase program over the next 5 years, which we interpret as a sign of strength. The end.
Questions?
So are you going to be buying Quanta stock?
I already have, sir.
So, reference to a partnership with Lane, does the Lane people want to comment on that at all?
On the Gemma partnership?
Yeah.
your nose.
Can you speak to that?
What's your question regarding the partnership?
Well, I'm just saying, I know that they referenced it. I didn't know if there was any context to that you wanted to provide.
Not really. I mean, it was just an opportunity that came our way, and we certainly are capitalizing on that opportunity and on that relationship. We do a lot of energy services around the fracking and in Pennsylvania, Ohio, West Virginia, and trying to grow that. I'm not sure. It's kind of a unique situation in that it's an actual construction of a power plant, which is not typically the type of work that Lane does. But so it's a unique situation. But we are finding ourselves getting more and more into that energy sector in support of fracking and those areas that I mentioned. It falls in nicely with all of that. So.
Okay. All right. Great. Well, thank you, Wanda. All right, we have one last presentation on this side. It'll be AECOM. Yeah. So let's get the AECOM group up. Mr. Willard. Are you going to log in the email and grab it? Yes.
You wonder about, they said the oil price is going down from 90 to 70. I saw it down at like 61, depending on what market you're looking at over the weekend.
Yeah.
Plummeting.
Somebody's still profit.
It's going to have a bottom someplace. Yeah, it says. Yeah, 43. Wow. We could use the brake at the pumps, though, for sure.
They'll probably get us in heating oil.
Yeah. Except for Carol, she's thinking, I don't care about the pump. I have an electric car.
That's going to hurt that.
Well, our utility bills, too, don't they have a
They're going
surcharge?
They're cranking up, right?
20%?
Oh, yeah.
Yeah, but the oil surcharge part of it
About halfway
should come down, right?
You'd think.
Don't they have a surcharge up or down based on the price of oil?
They just keep clouding the issue so they can keep making money.
Yeah.
All right, our final group is ready to go. AECOM, you have the floor.
All right, we see it.
Great.
So we're doing an evaluation on AECOM. I'm Patrick Grover.
Matt Shackton.
I'm Davis Rizika.
I'm Chloe Wing.
We also had a couple extra group members that had to go early, but Felipe Ross, Mike Hess, and Thomas Howard.
So AECOM is heavily influenced by the market. They have a beta of 1.455, and as we mentioned before, a beta of above 1 means it is significantly influenced by the market. And their peers also have high betas, with 4 out of 5 of the competitors we chose having betas of above 1. So Foster Wheeler has a beta of 1.829. Arcadis NV has a beta of 0.828. Jacobs Engineering Group has a beta of 1.475. Tetra Tech has a beta of 2.194, and Fluorcorp has a beta of 1.68. So as you can see, the industry as a whole is pretty much heavily influenced by the market. And then here is showing the beta for AECOM. So the engineering and construction industry proved to be a very risky industry because of the recession. So in 2009 and 2010, when the recession was kind of at its peak, a lot of projects were canceled. And then when the economy strengthened in 2011, the industry kind of bounced back and the market average also strengthened. So the projected growth rate for the next 5 years in the industry is 3.9%. And then here's a look at our 5 forces table of the industry. So currently the bargaining power of buyers is low because there are many different competitors. But in 5 years it is likely to increase as there will be more projects, thus creating higher demand and allowing buyers to demand higher prices. And since this industry is a service industry, then the bargaining power of suppliers is low. However, since in 5 years there will be higher demand for skilled labor, then they will be able to charge the higher prices, so their bargaining power goes up as well. And threats from substitutes right now is medium, and it's likely to stay pretty much constant over the next 5 years, and that's because of the price competitiveness and the relationships between clients and consultants ensuring future business. That's likely to stay the same. The entry and exit barriers to the industry right now is medium, as you need a degree and good knowledge of the industry. But in 5 years, it is expected to be lower because larger corporations will take over and smaller companies will not be invited to bid on contracts. And then finally, rivalry is high since there are so many firms and they can separate themselves with those established relationships and a strong reputation. And it's going to increase with the larger corporations and the European consultancy firms entering the industry. So AECOM has a more negative spread than the rest of the industry. So AECOM's spread is negative 2.56%, which is more negative than the industry spread of negative 1.54%, which means as they try to grow, they're actually destroying value. However, they do have a bright future predicted because they are starting to focus on diversifying their clients and moving into foreign countries so that they can reduce volatility by having all the risk in one country, and now they'll have risks in different markets. So then here's the WACC and ROIC of AECOM and some of its competitors. So as you can see, it's higher than, they have a higher spread than, or more negative spread than most of its competitors. And then here's a look at the ROIC tree for AECOM and its 5 competitors. So this shows the main drivers of the EOI ROIC. So as you can see here, the ROIC is driven by the EOI pre-tax ROIC and the cash tax rate. And then those are also driven by the operating margin as well as the invested capital over sales. So the ROIC in the engineering services industry saw a 58% decrease over the last 5 years. And one of the main drivers of this is the EOI pre-tax ROIC. So that saw an industry decrease of 51.6% from 2009 to 13, which obviously caused a decrease in the EOI ROIC. And also the operating margin is a driver. So when it decreases, then so does the ROIC. So for example, AECOM's operating margin decreased from 0.049 in 2009 to 0.039 in 2013. And then finally, the increasing invested capital over sales pretty much across the industry showed that since it was decreasing and it was increasing, it was lowering productivity and then thus decreasing ROIC. So one of the key competitors we found for AECOM was Fluor, and that's because it had a higher ROIC than the industry average. So it had an ROIC of 46.6%, whereas the industry average was 17.1%. So this could be because they had a consistently lower invested capital over sales, which shows that they had 0.065 in 2013 compared to AECOM's 0.342 and the industry average of 0.360. So that was probably a
key driver in how they had a more positive ROIC. So here's the cash flow available to investors, and a few of the things that led to the increase of CFI was the gross cash flow in the industry dropped, but AECOM saw a rise in gross cash flow. So AECOM saw an increase from negative $947 million in 2009 to $205.1 million in 2013. And also their gross cash flow of AECOM saw a rise, while the industry's gross cash flow saw a decrease. And for free cash flow, AECOM's saw a large increase from negative $539.4 million to $190.4 million. Meanwhile, the reinvestment rate also saw an industry rate decrease heavily by 108.4%, and AECOM had a pretty similar decrease from 71.3% to 5.3%. And then finally, AECOM significantly increased their dividends and buybacks from 2010 to 2013, and then they saw a large decrease in 2014, but they still overall showed increases.
All right, sorry. So now I'm going to take you through a multiples analysis. This was an analysis we took from Bloomberg, finding various multiples on AECOM and their competitors. So looking at the companies that are trading at a premium currently, you had Foster Wheeler, which is trading at, which showed a multiple of 10.25. The reason for this, they had a low growth rate, but the real reason they were trading at a premium is their very high ROIC. They had the highest ROIC of any competitors at 26%, and that really drove their multiple. Looking at Tetra Tech, they had a multiple of 9.07, and it was kind of the opposite of Foster Wheeler and how they came to their multiple. Tetra Tech had a very high growth rate of 7.75%, and then a lower ROIC of 11.3%. Moving down, you got Arcadis at a multiple of 10.01. And they were actually kind of different than the first two companies, where their growth rate and ROIC kind of fell in line with the industry averages and all the other companies, but they had a very low WACC of 7.7%, and this helped increase their spread and made them an attractive company. Looking at a couple of the companies that are currently trading at a discount, you have Fluor at 6.85%. Their growth rate at 3% and ROIC of 19% is as much for the reason as it is the WACC, which is the highest of any of the companies, of 12%. We predicted that this would probably go down a little bit in the future, but it's still a significant factor that they have the highest WACC of any of the companies. Jacobs, of a multiple of 7.77, they also showed a pretty decent growth rate and low ROIC of 12.5%, as well as a pretty high WACC of 9.7%. So moving on to the valuation, the current share price when this was taken was $33.73. The market is figuring a 2% growth rate in perpetuity, as you can see on the chart right here. The tax rate, as like every other group has said, based on the historical analysis, we took the average of the last 5 years to calculate the tax rate in the future. One of the years, I believe it was 2012, had an abnormally low tax rate of actually negative 238.8%. We took this out when we were calculating the historical averages. This was a major outlier, and found the tax rate overall to be 25%. EBITDA, we also used historical data to calculate the 5% EBITDA for the future. So in the final valuation, one of the main things we took into account is that margins are expected to increase due to increased demand. Because of this, we thought that the growth rate would increase more than the market was showing, and that the EBITDA margin would increase, and that the tax rate would stay constant. While we, in changing this, we increased the revenue growth rate to 3% in the first couple of years and then 2% in perpetuity. We also increased the EBITDA margin from 5% to 5.5% and kept the tax rate constant. So the final share price that we calculated was $35.65 per share, which is about $2 greater than the current stock price. So our recommendation is hold. And looking at the final ROIC chart, you can see that it falls in line with many of our projections, with an ROIC a little bit in between 14 and 16%. So we thought it was a fair indicator of the market. Any questions?
Questions from Lane for AE Comms Group?
I think we're good, Joe.
Okay. Well, again, thank you, AE Comms Group.
Thank you.
And
All right. Nice job. We appreciate you putting all that time and analysis into all of this.
yeah, and thank you to the Lane people that sat through the presentation. So again, Mike, I mentioned that at the beginning of the session as well, if this was probably a more technical financial presentation, if it would be helpful, we can set up some sort of a answer key to some of the key metrics and obviously try and simplify this if other people are trying to do this. So I can talk to you about that tomorrow if you want.
Okay, great.
But thanks again. Really appreciate everyone's time and tuning in. Have a great day.
Thank you. Thanks.
All right, bye. End the recording. Yeah, thanks, guys.
Thank you, Professor.
All right.
Sorry, I wasn't business.
Oh, that's okay.
I really thought it was business casual. See you on Wednesday.
Yep, take care.